Your 60/40 is built for yesterday's market. Before 2026, we're heading into a K-shaped recovery where winners and losers split hard. And a volatility trap for anyone chasing the S&P at all-time highs. Markets are pricing a perfect soft landing. I'm positioning for a macro-first reality where rates drift lower while growth stalls and price returns can flatline. In sideways markets, high fees and index concentration matter more because they compound against you. Stay. I'll show you the only 3 ETFs I'm buying before 2026 and exactly why. 60% defense, 25% AI-enabled growth, 15% small cap value. First, let's define the volatility trap you need to avoid. So let's talk about the volatility trap no one sees coming and how it shows up in real portfolios. What if the next 2 years don't reward the investor who chases every green candle, but the one who stays focused on steady cash flow and discipline? Right now, markets are acting like the soft landing is certain, clean, no turbulence. Stocks at highs, spreads calm, and a lot of people projecting the last 6 months into the next 6 quarters. But the macro signals don't line up cleanly. A K-shaped split is forming beneath the surface. Strong balance sheets and pricing power on one side, weaker operators and rate-sensitive models on the other. That's a recipe for chop, not collapse, just a path where prices hesitate while fundamentals diverge. Here's where the tension shows up. Leading indicators aren't unanimous anymore. Purchasing activity has slipped in some sectors. Earnings are rising for fewer names, even as headline indexes look fine. And with valuations already stretched, the market leaves less room for error. When the crowd leans toward a perfect outcome, even decent news can disappoint, and small misses can sting. That's how a sideways tape forms and persists. That's the volatility trap. Prices grind flat for months, then jump or drop in quick bursts. If you chase each pop, you buy higher. If you bail on each dip, you sell lower. You end up harvesting losses while the index goes nowhere. It feels active and engaged, but the account doesn't move. Think about it like driving in stop-and-go traffic. You stomp the gas, then slam the brakes, but your exit isn't getting closer. The way through isn't more pedal, it's a smoother pace and a lane that actually advances. In markets, that means owning cash flows you can reinvest and pairing them with selective growth backed by real economics, not just momentum. History backs this up. When you start from elevated price to earnings levels, forward returns tend to cool. In those stretches, a bigger slice of total return comes from dividends and buybacks doing quiet work in the background. From 1930 to 2024, about 40% of the S&P 500's total return came from dividends. And when price appreciation slows, that share often rises. The engine is reinvestment, a steady drip that compounds even when the tape is stubborn. You can already see the fragility and concentration. Equal weight versions of the index lag cap weight, which means a handful of heavyweights carry most of the gains. That concentration cuts both ways. Great when they run, tough when leadership rests. So how do you turn chop into compounding without overtrading? You build a barbell that marries durable income with targeted upside, letting cash flows buy dips while selective growth captures the few engines still expanding. The point is to avoid single bet market exposure and keep costs from siphoning returns in a low-growth regime. You want a structure that converts volatility into more shares, not more stress. If price can stall for years, you still need a way to move forward. That starts with defense that actually pays you while you wait, without reaching for junk yield that disappears when conditions tighten. Which is why the core starts with defense that compounds, specifically 60% in SCHD. You use defense that compounds. That's why 60% goes to SCHD, the engine built on cash flow-rich companies that have paid dividends for 10 plus years and pass a strict quality filter. It doesn't chase the highest yield on the screen. It favors durable businesses with the balance sheet to keep paying. And it refreshes the lineup with quarterly rebalancing so weaker names don't linger. In a slowdown, that ongoing cull matters more than a flashy yield because it keeps the portfolio tilted toward the firm still generating real cash. And it does it at a 0.06% expense ratio, which preserves more of every dollar you earn. High yield alone isn't a strategy. When a payout looks too good, it often signals a business under stress. Those yield traps tend to break right when you want stability. The goal here is sustainable cash generation and enough financial strength to ride through tighter conditions. SCHD's process leans on companies that fund dividends out of profits and still have room to invest, retire shares, and keep leverage under control. The quality work happens up front, prioritizing robust cash flow relative to debt, profitability, and return on equity. So you're not paying for yield with hidden risk. Quality screens are your guardrails. Dividend sustainability filters out names stretching their payout ratio. Then the quarterly rebalance does the hard work, removing deteriorating businesses before they become problems and adding firms whose fundamentals improved. In choppy markets, that rules-based pruning is what preserves the yield and the staying power. When valuations run hot, dividends tend to carry more of the load. That's where reinvestment turns steady cash into growth. Let's run a simple decade. Say prices grow 0 to 2% a year, while yield sits around 3.8%. If you reinvest that cash every quarter, you're consistently buying more shares, especially on dips. After 10 years, even with muted price gains, the compounding from those reinvested payouts drives a meaningful total return, because your share count climbs and each new share starts paying too. There's a tax angle you can't ignore. A yield near the high threes creates tax drag in a regular brokerage. Putting SCHD in a Roth IRA or a traditional 401k preserves more of the compounding. Then make it automatic. In Fidelity, toggle dividends and capital gains, reinvest. In Vanguard, set dividends, reinvest at the position level. In Schwab or Robinhood, enable DRIP in settings for the holding. Once it's on, dividends buy more shares without creating a current tax bill in those accounts. That turns volatility into automatic dollar cost averaging. No extra work needed. Defense is the base, not the entire play. Quality income keeps you moving even if prices grind sideways. But you still need selective offense to capture durable growth without overpaying. So let's add a targeted slice that taps AI tailwinds while keeping costs and concentration in check. Here's where the selective offense comes in. Targeted offense, 25% in SCHG for AI-enabled growth. What if you could tap AI tailwinds without betting the farm on a single index or stock? You don't need to chase every headline or pick one winner. You can own a disciplined slice of the leaders with 25% in SCHG and let cost control do quiet work in the background while growth compounds on its own schedule. SCHG gives you low-cost, large-cap growth exposure with rules that pull in mega-cap names driving AI investment. It isn't a single-theme bet, and it doesn't rely on one sector to carry the whole load. The methodology builds breadth across established growth franchises, so you capture the key players without overcommitting to a narrow basket that can whipsaw when sentiment flips. And with a 0.04% expense ratio, you keep more of the upside compared with pricier funds that take the same risks with higher drag. The real risk isn't AI, it's paying any price to be involved. When leadership concentrates and fees stack on top, long-term returns leak even if the story is right. That's why cost matters. A 1% fee looks small on a fact sheet, but over 30 years it carves a large chunk out of your gains and can move your target date by years. SCHG's 0.04% expense ratio keeps more of the growth you already earned, which is the part you can actually control. You still need a filter for the hype. Watch the internals of the top holdings. Return on invested capital should rise as AI spending scales. Put simply, ROIC measures how much profit a company generates for every dollar it invests. If they pour billions into data centers and models, you want to see those dollars come back as higher cash returns, not just higher headlines. Revenue quality matters. Recurring revenue, backlog visibility, and margins that widen alongside growth. CapEx to revenue should trend toward efficiency over time. When ROIC improves alongside beats and guidance lifts, multiples have support. If the beats continue, but ROIC slips while CapEx stays heavy, the story weakens. Here's how that plays out. A leader reports another quarter of double-digit growth. Gross margins hold, and ROIC ticks higher as new AI services convert to high-margin revenue. That mix can justify the multiple and extend the move. But if late 2025 brings slowing AI revenue contributions while spending stays elevated, that's your trim signal. You don't abandon growth, you right-size it. This sleeve isn't set and forget, but it also isn't a full-time job. The rule is simple. If AI growth cools and ROIC stalls, rotate a slice of SCHG back into SCHD to reinforce the base. Keep SCHG in a Roth if you can. It's a capital appreciation play and tax-free compounding helps. But it also works in a taxable account because the yield is low and the drag is modest. With offense calibrated and rules in place, the last piece targets upside where policy shifts can change the math fastest. That's where a selective small cap value filter can turn a headwind into a tailwind. The snapback bet, 15% AVUV for a 2026 small cap re-rate. If you're skeptical, you're not alone. Small caps have trailed for years. That's exactly why a focused approach matters now. Why own the most unloved corner of the market? Because rate cuts don't lift all boats equally, and the company with floating rate debt feel the tide first when policy turns. Here's the thesis in plain terms. A large slice of small caps borrowed short and paid the price as rates climbed. Interest expense ate into margins, and multiples compressed as investors favored mega caps with fortress balance sheets. In a cut cycle, that pressure can reverse. Lower coupons flow straight to the income statement, widening net margins and giving investors room to re-rate businesses that were priced for struggle rather than survival. But broad small cap beta won't do the job. Nearly 40% of the Russell 2000 is unprofitable, and buying the whole basket means funding zombies that chew through cash. You want a filter that keeps the capital light grinders and avoids chronic money losers. That's where AVUV earns its slot. It tilts towards smaller, cheaper, and profitable companies, and its rules-based approach screens out firms that can't cover their cost of capital. You're not paying for a glossy story. You're buying operating discipline. There's research behind the posture. After tightening cycles, the small value premium tends to show up when credit conditions stabilize. The gap between price and fundamentals typically narrows as fear fades and lenders loosen a notch. AVUV is built to live in that zone, fishing where the rebound historically has bite rather than trying to time a single macro print. Let's simplify the math. Take a company with $200 million in floating rate debt at roughly 7%. If policy cuts bring rates down by about 2 percentage points, interest expense falls by roughly $4 million a year. On $25 million of pre-tax income, that's about a 16% lift before any operating improvements. Net margins push higher. Free cash flow improves, and a discounted price-to-earnings multiple has a reason to move toward its historical range. That's the snapback you're aiming to catch. You still need patience and a clear clock. This is a 3 to 5 year sleeve built to benefit from an anticipated 2026 rate cut cycle. It can lag for quarters before the re-rate shows up. That's why it's 15%, not 50%. The sizing respects the path and the volatility, while keeping you exposed to the upside if the cycle cooperates. Don't yank it just because growth beats it for a reason. The payoff here is structural, not tactical. Risk management is straightforward. If credit spreads widen materially and policy support doesn't arrive, keep the allocation steady and avoid chasing. Let the rules do the selecting rather than trying to front-run every headline. The process beats timing over a multi-year window. Now let's put the whole thing on rails. How to allocate, when to rebalance, and where to hold each sleeve so the structure itself becomes an edge. Let's get concrete and make the setup workable day to day. How to run it. Allocation, rebalancing, and tax placement. The edge isn't just what you buy, it's where you hold it and when you shift risk. The allocation is simple and intentional. 60% SCHD as the income engine to steady returns in a flat tape. 25% SCHG for disciplined exposure to AI-enabled leaders with cost control. And 15% AVUV to capture a rate cut snapback where small value historically responds fastest. The mix balances cash flow, selective growth, and cyclical upside so each sleeve has a defined job. Your maintenance plan is a light touch quarterly review. Set tolerance bands around each sleeve, plus or minus 5 percentage points relative to target. In practice, that means SCHD's lane is 55 to 65%, SCHG's is 20 to 30%, and AVUV's is 10 to 20%. Only trade when a sleeve drifts outside its band or when business signals flip. If SCHG rallies to 32%, trim it back toward 25% and refill SCHD or AVUV. If AVUV slumps to 9% while credit still looks stable, add back to target. Keep trades minimal and let sizing do the heavy lifting. Layer on a simple dynamic overlay. If AI revenue growth clearly decelerates and ROIC stalls across key leaders, redirect a slice of SCHG into SCHD to reinforce the base. You're responding to cash math, not headlines. If credit conditions ease and a cut cycle begins, hold AVUV at target and let the operational leverage work. This sleeve is built for falling funding costs. Avoid over-adjusting. Make one change at a time to keep the system clean. Tax location increases your net return without taking more risk. Put SCHD in a Roth IRA or traditional 401k to avoid dividend tax drag and let the roughly 3.8% yield reinvest seamlessly. Keep SCHG and AVUV in taxable accounts to lean on long-term capital gains treatment and defer taxes until you sell. Quick summary to remember: income to tax-advantaged, growth and value to taxable for deferral. Automate what you can. Turn on dividend reinvestment for SCHD in tax-advantaged accounts so every payout buys more shares by default. In taxable accounts, consider taking dividends in cash to cover liabilities and avoid surprise tax bills. Then direct contributions where your allocation needs help. Set calendar reminders for the quarterly check so the process never drifts. Stay cost conscious. SCHD at 0.06%, SCHG at 0.04%, and a low-fee small-cap value sleeve keep the blended expense lean. Resist stacking pricey active funds on top of factor and growth sleeves. Every basis point you save compounds quietly in your favor. Control risk before it controls you. Cap any single sleeve at 65% so leadership doesn't morph into concentrated risk. Skip leverage. You don't need it when cash flows and valuation discipline do the work. Keep 3 to 6 months of expenses in an external emergency fund so market volatility never forces a sale to cover life expenses. Run the rules. Let time do its compounding and keep costs and taxes working for you as the cycle evolves. Which brings us to the takeaway you can act on today. In a K-shaped rate-cutting world, returns flow to cash flow, cost control, and selective growth while rear-view strategies stall. You don't need a perfect forecast. You need a process that gets paid to wait and participates when leadership earns it. From 1930 to 2024, about 40% of the S&P 500's total return came from dividends, which is why income matters when prices stall. Build the 60-25-15 barbell. Set wide rebalancing bands, fix tax placement, and commit to 2 years of disciplined execution. Don't chase the last high. Own the cash flows. Keep growth sized and rules driven and stay positioned for 2026.